This is our First Friday event, and just a quick sneak peek on what First Friday is. This is our community and helping investors to evaluate, understand risk, and put risk to work. And that's what we're doing here at Spartan Investment Group. On the screen behind me, you can see our internet address. If you'd like to read up on who Spartan is, feel free to go there. By way of review on who Spartan is the nation's 40th largest self-storage operator. We're really proud of that. Spartan started about 10 years ago, and we've muscled our way up to close to the top of the list just by grit. So we're very proud of what we're doing here at Spartan. Looking backwards, we have raised a good chunk of assets from individual investors just like yourselves here in the audience and those of you online. We've raised about $200 million, maybe a little bit north of that. We have about 110 employees. That number keeps moving higher. Blame Ryan for that. And we own 67 or 68 properties, depending on where we're at with our property in Lafayette, Georgia. So we're that number keeps moving as well. As an aside, on the whole managing risk topic, I do want to remind all of you, and please feel free to email me at the address on the screen. Spartan has created an Excel file that is really good for helping individual investors track a portfolio of private investments. And I think that the sequential maturity of investments, monitoring cash flow that you've received versus what you were told you would receive, you sum all of those bits and pieces together, and that makes up, or that's the composition of good portfolio management. So if you're looking for a tool to help you track or get your arms around what you've got and where you want to go, please do reach out to us for the portfolio tracker. Investor Relations built that. We want you to be able to use it. So reach out for that tool. This is a quick snapshot of what the tool looks like as you get it populated and moving forward. Let's not spend a lot of time there. We're just going to get to the superstar of the day in just a moment here. As a reminder, Spartan Investment Group in March is launching 3 funds, all focused on self-storage. One of those funds is a debt fund, pays you either 8% or 9% on an annual basis, and that comes monthly. We also have 2 equity funds. One is a more conservative income fund is what we're calling it. It's just value add self-storage, existing businesses where we've got room for expansion and construction. That'll start off with distributions between 4 and 5% is our anticipation. And then we have a more risky growth fund, which is new construction. And for investors who participate before the end of April, we are giving those investors a share class higher. So a $50,000 investment receives a share class that later, after April turns to May, they'll receive a share class that is reserved for the $1 million investor. So there's some incentive there that's palpable. It's a bump of about 12 or 13% when you move from a 7% preferred return to an 8% preferred return. Anyway, see the website for more information or scan the QR code. That will be the last slide. If you're online and you want to get plugged in with Spartan, just at your PC, scan that QR code, add yourself to our distribution list, and you'll have resources available to you. Okay, enough of Ted flapping his big yap. So the superstar is Brandon Bruckman, and I first met Brandon face-to-face in Wisconsin probably about a year ago.
I think that's right, yep.
When we were doing a property tour at one of the facilities that Spartan bought in 2021. Like minds connected, and just by talking and visiting, I learned about Brandon a couple of things. He has a lot of responsibility. Brandon is an investment advisor representative, registered with the SEC, and the firm that Brandon represents is a registered investment advisor. So the firm is the RIA and the individual is the IA. there's a fiduciary component here that is not to be taken lightly. So that's the hot seat that Brandon is sitting in. And Brandon, with that being said, walk us forward, if you would, please.
The seat gets hotter. The lights on you over and over again. Yeah, and it's a seat that that we take seriously and we sign up for, is to be a fiduciary, because we think it's the only standard of care to have in our space. So there's a couple different things that I want to talk to you guys about today, and I want to start with what I wanted you to walk away from the presentation with. So we're going to talk a little bit about why folks sell, and we're going to talk a little bit about 1031 exchange. So the big things on 1031 is I want you to walk out of here and at least have a game plan of, I'm going to do everything that it takes on these slides to make sure that this doesn't fail. That's the biggest thing I want you to walk away from. I could give you a 60-page presentation about 1031 exchange, but let's be honest, most of it you probably won't remember. I'm going to give you one page, and you're going to walk out of here with the ability to not fail on your exchange. And that's the biggest thing I want you to take away from it.
And Brandon, if I could interject, if we have questions during your presentation, those of us in attendance, feel free to ask the question. Brandon will repeat the question so that those online understand what the question is, and we'll just walk through it. So conversational format.
My God, please stop me, yes.
If you're online, type it in.
Yes, if you're online, tap it into the chat box. Main man Roy will send that to me. We'll get it to Brandon.
Yes, yeah, this works best if you ask questions instead of listening to me talk and flap my big mouth the whole time. You don't want that, so please ask questions. We're going to talk a little bit about some of the passive options that are available for folks as they go through a 1031 exchange. We'll hit opportunity zones from a very high level. We'll talk about an UPREIT scenario. What does that even mean? So I'll describe that. And then finally, I do want to talk a little bit about how you're thinking about estate planning and how you're thinking about passing those assets to your heirs. So those are big things that I want you to sort of take away from the presentation. Who the heck am I and why am I talking to you? So Ted alluded to it a little bit. My name is Brandon Bruckman. Our firm is Insight Investment Advisors. Myself and my partner Josh Wright, who lives in Kansas City. I live in Milwaukee, Wisconsin. So I'm happy to come out here and it's not raining. That's a huge bonus. For folks that are familiar with Milwaukee in that area, this feels like a heat wave to us. Was it 35 today? That's amazing. Are you kidding? I love it. I didn't even bring a jacket on this trip. This is absolutely amazing to me. People are looking at me kind of weird on the street with no jacket on, I have to tell you. But in terms of my background, that's my lovely family there. My wife is actually bopping around town right now having a good time. So catch up with her later. We turned this into a little bit of a fun trip too. So that's good. But in terms of background, I've spent a lot of time, my roots are really in public markets. I spent a lot of time at a hedge fund, rather large hedge fund, and I walked through the financial crisis, which has left me with scars that I can't even describe how big they are and how deep they run. But it really instills in me a level of risk and care that we have to have with clients, and expecting really the unexpected, because that was an unexpected situation, to say the least. So that's really where my roots come from. And our goal is to really help clients. Most clients come to us looking to transition from active managing real estate to passive. And so our role is to describe to them what's possible and sort of walk them through that journey. But that's who I am. Why are you here? Probably a lot of reasons why you're here. There's food, so that's probably one reason, and it's free. It's free, right? So the food's free, that's great, and it's great to meet up with people. But when we talk to people about selling their investment properties and doing that 1031 exchange, something's usually happening with them. It's usually not economics first. It's usually a personal decision, especially to cash out. It's a very personal decision to talk about that and why folks are doing that. So if that's something that you're thinking about, I want you to really be in touch with why that's happening. It's very much a thought process there. I started making these slides 2 years ago, and I'd still say that's true. Even though we've seen real estate prices come down, this market is still running pretty hot. There's still values here that I think a lot of long-term holders of real estate are still shocked that they're seeing at this point. So that can still be, economics are part of this, and that's somewhat of a reason it may start you to think about selling. One of the stats that we talk about when we talk about selling and 1031 exchange that I think is really surprising to folks is Ted and I walked through these slides before we started, and you made a face when I said this number. There's a study done by UCLA about 1031 exchange. Most investors, even if they've 1031 before, end up paying the tax anyways at the end, which I found shocking to me. Like, why in the world is that happening? Why are investors deciding that after all these years of building up equity and value, why would they decide to sell and pay the tax? Why is that happening? It's shocking. That number is close to 90% of those investors are paying the tax. So we'll talk about some ways that we can avoid that. But I think a lot of that is built around mindset. So when we talk about these solutions, we're hearing two things. I'm never going to sell. I'll die and pass these assets to my heirs. Or, you know what? I'm just going to sell, pay the tax, and go to the beach, and it'll be fine. Those are the only two options that I think people are thinking about. So we'll talk about things that can go beyond that. All right, here we go. 1031 exchanges, the basics. So I sort of want to walk through this slide, and this is where I really want to open it up for questions. But I labeled the things on the screen here that are absolutely critical for you to do in a 1031 exchange, that if you don't do, and I get these calls probably once every other month of folks that have done something terribly wrong up front, and I can't fix. So let's avoid that before it happens. So at a very high level, I almost want to start on the right and talk about getting a CPA involved. This is the absolute most important thing, I think, before you even start to think about a 1031 exchange. I recently interviewed a CPA named Brandon Hall, who has about 700 different real estate clients across the country. And he's made a lot of posts recently on LinkedIn about, hey, you really want to check some of your tax forms and figure out what losses that you have that you may be carrying forward, that you may not have realized that you have, and how you would apply those. You might not need to do a 1031 exchange. So do please start with that CPA.
Okay, so
Yeah.
so I think that's form 8582, where you're tracking the unused. Okay, that was a grimace right there.
Yeah, I can't wait to respond to this.
Okay, wait.
This is the great part where I say I am not a CPA or a tax consultant. Please consult with your CPA and tax consultant. But I do believe. I think you have that form right.
Okay.
So I continue.
Well, yeah. So am I tracking your train of thought?
100%.
That the sum of the losses there may be used to offset a gain if you're an active manager and you decide to pull the ripcord.
Exactly.
Okay.
And so I've walked through this with folks, and we've been very far down the line. And wait a second, I actually talked to my CPA yesterday, and this gain's actually really manageable from a tax perspective. It's not as horrific as it could be. I don't really need to do this. It's like, well, we probably should have started there.
Yeah.
Would have been a good place to start.
That's so interesting. So, yeah, my mind is spinning. That's significant because with the amount of transactions the last couple of years, there's a lot of folks that have $300,000, $400,000, $600,000 in passive losses.
Yeah.
Sorry.
Yeah, no, it's very important. And to go a little deeper on that, we have a client now who's made the decision to transfer a massive portfolio that they have to go passive, and they did the full 1031 exchange. They're actually sitting on a lot of active losses inside of that, which was their business, that they really can't utilize. Like, we really should have done this a lot different, or done a lot more planning with your CPA before we went through this process, so we could get our hands on those losses inside your business. So we'll have to work really hard to go get them. So this can get really complicated if you're not, you really got to utilize that CPA.
So, and I just want to crystallize something for Spartan investors or folks that are sizing up Spartan and trying to get to know us. Last year, 2021, the offering was Spartan's Storage Fund 1. And a $20 word is bonus depreciation. And the short version on the bonus depreciation is that 30%, roughly 30%, is received by the passive investor via a loss on the K1, and that's your passive loss. So if it's $100,000 invested in a typical year for a Spartan investor, they're going to see a $30,000 passive loss. Mm-hmm. And so that's the number, and the sum of those passive losses from a portfolio of investments, mm-hmm. That's what you're just poking on that one right there.
Yeah, and it's very important that, again, the CPA is so critical here. It's very important for the investor to understand what's passive and what income can I use that passive loss against, and what's active and what income can I use the active losses against. Yep. It's very important that folks understand that. These two things rarely can be mixed together, and you've got to get a CPA on the case to really understand where that can be utilized.
Good.
So that's number one, so please do that. Number two, where I've seen this blow up over and over again, is not having a qualified intermediary. I get phone calls where folks say, hey, I love what you do. I'm holding a check with $1 million. I'm ready to do what you guys do. Let's get going. I'm like, you're holding a check for $1 million? That is a huge problem. You cannot have that. So you need a third party that sits in between yourself and that closing that can take possession of those funds for you. They're called qualified intermediaries. Easiest way to do that is to talk to your closing company and ask the question, do you provide qualified intermediary service? Most do. It's as simple as filling out a couple forms and documents. When you see that closing statement from your property, it has to list that company taking possession of those funds in your name. They have to take those possession. If you're holding a check, you cannot execute a 1031 exchange. I can't save it. There's nothing I can do. It's over. So you have to have those involved. If your title company doesn't offer those services, there's a variety of national firms that will provide that qualified intermediary service. Connect them with your closing company and you're off and running. So easy stuff. So that's a pretty easy step. Here's the hard steps that make this really messy. The time requirements. I do a 1031, I close today. I have 45 days from today to identify replacement property. There's rules to do that, and I'll get into those in a second. But you have 45 days to identify something that you may want to purchase as a replacement. Second deadline, 180 days from when you close. You have to close on that replacement property, some combination of those replacement properties. So 180 you look at and you go, okay, I can kind of do that. That's not a big deal. 45, that timeline squeezes fast. So it's very important that you get to my second to last step. You got to have a plan here. There has to be a plan, and this is hard to do from just managing your own time. Of thinking about, I need to sell this, but while I'm doing that, I also need to think about what I'm going to buy. You really got to do that at the same time. So when you hit closing and you start to get to your 45-day period, you're way down the road. So where I see people fall in trouble here is they take these processes as two. I'm going to sell this, and then I'll go worry about what to buy later. This becomes a huge problem. And then that timeline squeezes on you. So you got to have a plan here.
Seems like you want to be, it seems to me like you want to be working to identify where you're going with the proceeds that are held by the QI before you get to the closing table. I mean, that's when the homework needs to happen.
100%.
Okay.
100%.
By the way, has anybody in the room done a 1031?
Yeah, I should ask that.
Okay, we've got
One,
1, 2, 3, 4, 5.
That's good.
Any observations or questions about that process that the group would benefit from hearing about?
It's nerve-wracking.
It's
nerve-wracking.
Okay, for those online, the comment was, it's nerve-wracking.
Yes.
That doesn't surprise me, Joe. Yeah. Okay.
Others it was easy apparently. It was no big deal.
Yeah.
They're sort of laughing. Like, I feel some pain there in that. They're maybe not as easy as we think. The other item in the middle there on the slide that I hear all the time is, what is this like-kind requirement? What does that mean? It's like, can I sell my multifamily and buy a storage facility? Absolutely. So like-kind is a very wide definition from the IRS. It basically says any real estate, investment real estate that you're selling is like-kind of something else. So the widest or the broadest example I can give is we have some clients that are farmers and have sold their farm and have looked to transition into passive real estate assets. So even that wide of a perspective can be done here. So no worries about the like-kind requirement, really.
So if I could pause you for a moment, a couple of questions just popped up. So the first question is, my siblings and I will inherit farmland. Is this eligible for 1031 if we decide to sell it? The family is currently held in trust.
Got you. So the big thing that I heard there was inherited. So start with your CPA on that and figure out, do you have a tax bill there or not? Because you could get a stepped up basis there in that farmland, and you may not have a taxable bill or a taxable outcome there at all that you have to deal with. So definitely start with your CPA. Generally speaking though, yes, that would be, you could qualify that as eligible for 1031, but you may not have to.
Okay. Another question. We've got a total of three more. Do you expect to have the QI to carry insurance to protect then potentially protect if the QI, the qualified intermediate, potentially makes a mistake?
I'm going to frame that question a little bit different, but I think I get where we're going is, how do I know this QI is a reputable firm that can handle my money and have my money? If you go to Bigger Pockets and you want to read horror stories, if this is intriguing to you, They're out there from qualified intermediaries taking funds and going and buy cars and houses, all the American greed type stuff you could imagine. That's happened in this space. Qualified intermediary space is very unregulated. So I encourage folks to spend a significant amount of time understanding that company is reputable and insurance is something that they should look for. But I think they should dive a little bit deeper on that to understand that company is somebody that they're comfortable holding their money for. Because almost anybody can be a QI.
Okay. 2 more questions. If I'm selling vacant land, can I exchange that into a multifamily property?
Sure.
Okay, so that, yes.
But ask your CPA first.
But ask, yeah.
Yes.
Last question, can you 1031 exchange into a syndication?
Ooh. Did you ask that question?
I did not.
Ryan, you asked that question? I feel like we've been talking about that question here already. The answer is yes and no. So it depends on how the syndication is structured. If the syndication is structured as a partnership and you're entering as a limited partner, that's a no. You can't do that. So a limited partnership in the eyes of the IRS technically isn't real estate, it's a partnership, even though that partnership holds real estate. So that's not going to work. Some partnerships will offer what's called a tenant in common agreement as a portion of that syndication. That you could 1031 into. But as we've talked around here, and I think you'll actually, if you talk to the syndicator or the sponsor of that deal, they'll tell you that doing that tenant in common is very difficult.
It is.
And it's very tough for them to do. But it is a possibility. You can do it.
Okay.
It's good questions.
Yep, back to you.
Back to me. Any questions in the room? It's a good stop point. Go ahead.
Yeah, maybe just a question back towards Ted and Spartan. So how does Spartan operate from offering tenant common structures or not?
Yeah. So the question for those online was, what's Spartan's perspective? Do we do 1031s or do we receive 1031s? We used to, we don't anymore. The complexity is, we just don't at this point. I think Aubrey?
So I know for some of the bigger institutional players, they have like 1031 products where folks who are doing 1031s can buy in using like Delaware statutory trust. How is that different than like this partnership or the form that you were talking about?
Were you looking at the slides beforehand? Okay. So the question in the room was, some larger players do offer what's referred to as a Delaware statutory trust, which in essence is a syndicated format that would accept 1031 funds. That's literally the next slide. So I'm going to transition and talk about that. The answer is yes, you can. Hence why those were created for that exact purpose.
Cool.
It's a good one. Others? Good? Can always ask at any point during the presentation. So great question about Delaware statutory trust, and that's where myself and our firm spends most of our time, is taking investors from active to passive. And that's the vehicle that we'll do it into is a Delaware statutory trust. What the heck does that even mean? It's a mouthful, Delaware statutory trust. It is, in essence, a form of syndication that the IRS has blessed that will allow you to do a 1031 exchange into. So you are a fractional owner of a larger property with other investors. It has the setup and stylization of a syndication. However, when the IRS looks at it, they look at this vehicle and they go, oh, you own a percentage of that property. So when you complete a 1031 exchange, you're filling out the name of this Delaware statutory trust and the address. It's your replacement property in a 1031 exchange. So a lot of questions we get all the time is like, well, what is this? Where's the 1031? The two work together. This is your replacement property, is a Delaware statutory trust. So high-level points I'll hit on this. Fractional ownership, very much like a syndication. There's a different risk and reward component here. Most of the Delaware statutory trusts that are offered are larger institutional-like quality properties. So you're not going to see value-add multifamily here. You're not going to see a lot of that work, and a lot of it is because of the structure. It's a closed-end structure. You cannot refinance inside of the structure. You can't make capital calls. So all the money that the sponsor needs to do the work in that property has to be gotten at the fundraising. They cannot go to seek that later. So it really limits the type of assets that are purchased here. Hence, the risk of those assets is much smaller. The people coming to this space are not looking to make, frankly, 20% IRRs. You're just not going to see that in this space, right? So that's what the vehicle is designed for. Yes.
Can I poke around there? So
Please.
So I'm very proud to say that Spartan has never put out a capital call, an unannounced raise of capital.
Mm-hmm.
I think I heard you just say that in a TIC, or I'm sorry, in a DST, there is no capacity for a capital call.
Mm-hmm.
What happens if a surprise happens? Yeah.
This is level 303. We'll go there since you asked the
Okay.
question. This is good. There is a trapdoor mechanism for this, and it's called a springing LLC. So what the DST sponsor will do is they'll take that asset out of the DST structure, they'll put it into a limited liability structure, and they'll do what they need to do from a financing and refinancing the debt on that structure. And in some cases, we've seen this, and it's happened recently, where they'll take and actually put that back into a new DST structure. Because if you leave that in the partnership, we're back to the problem that we had before with syndication, right? I can't syndicate into a partnership. I definitely can't sell the partnership at the end and have that same tax benefit. The IRS will look at that and go, whoa, wait a second. Like, you own a partnership now. You own a part of this LLC, right? You own tax on that. It'll actually negate that previous tax advantage that you had in the 1031 exchange. So it's very important for that sponsor to be able to put that back into a DST structure so I can exchange again. That is level 303. We've seen it happen. The best sponsors are able to do what I've been referring to as like legal hula hoops. They're like, the hula hoops are on fire and the lawyers are jumping through them. That's what this feels like, but it's doable and it can happen.
Yeah.
So there is a trapdoor there.
I'm going to hold you up just a moment.
Yeah.
So the online question with the farmland came back with a follow-up question.
Yeah.
What are the general situations where farmland would be eligible for a step up in basis? And I think maybe that should be as specific as farmland or other real assets by way of a step up in basis.
Yeah, and that's one of the items of the tax code that we think is almost more beneficial than the 1031 exchange is the basis step up. So this is a way for you to pass to your heirs an asset that moves from the price that you purchased it at to a valuation of when you die. That asset moves from here to there. So in essence, eliminates the tax. Farmland in any of those situations, and it'll be very specific to their estate. So again, please go talk to a CPA. But it's not specific to farmland, it's specific to a broader array of assets.
Okay, and I think that to piggyback off of that, I think that's the unified credit. So all of us have a one-time exemption that gets used at death, and it covers the federal tax on an asset that transfers to your beneficiary. And I think the unified credit right now is like $5 million. It's been at least 5 years since I've looked at this.
Yeah.
So the unified credit, the answer to this question is as simple as half an hour with the CPA.
Yeah, or less, hopefully.
Yeah.
Yeah, but that's a good point that you make, and that's why I referenced you really have to understand the estate and what's possible there, because you could be hitting that limit.
Yeah.
Exactly, and that would be an issue that you'd have to work through with a CPA, probably an estate attorney as well.
Good.
Oh, more questions?
I think that's all we've got.
That was okay. Good one. Rounding off this slide and some other characteristics of the DST. Control, and this is the biggest one for an active investor. Most of our clients that come to us have managed property for 20, 30 years. They call the shots. In the DST, they call no shots. All those shots are given to the sponsor to execute the operation, and when that asset will be sold is up to the sponsors, not up to them. So those that have been in syndication, it's a very similar setup of being a limited partner, the way that you sort of feel in this asset. So those are the big components there on Delaware Statutory Trust. The biggest thing I want to drive home here is you don't have to, even if you want out of active management, there are ways, and this is one way, for you to continue to defer tax, complete the 1031 exchange, get to passive income. You can execute this with a Delaware Statutory Trust. Questions any questions in the room? I'll neglect our room friends. Good? Okay. They're still eating, everyone, online, so they're occupied. Ask questions online. I did that.
I think we're good there.
Yep, good. Awesome. So other options. All right, I don't want to do a Delaware Statutory Trust. What else can I do? I don't want to do a 1031 exchange. What else can I do? So a big thing we've been spending a lot of time talking to clients about are opportunity zone funds. And frankly, there may be an economic advantage if folks are seeking higher returns and a bit more, in our opinion, risk. This could be an option for folks. So if you utilize an opportunity zone, you actually don't need to perform a 1031 exchange at all. So you can take that off the plate. The big thing for investors here is to think about is you have 180 days. That rule still is in place. So you have 180 days from sale to investment in an opportunity zone fund. You have to complete that transaction. You do not need a qualified intermediary here. So you can hold the check in your hand. So we'll use this strategy if there is someone who comes to us. That's my next statement to them is, hey, you're holding a check. I might have something else for you to do that isn't a 1031 exchange, and this can be an option. We started looking at opportunity zone funds back in 2020. We've looked at all 8,400 of them. It's been an interesting activity, to say the least.
Do you have a document that can be viewed by someone that's watching this online about each of those 8,400 or characteristic about those? It seems like that's a tremendous amount of work and a resource.
It is. If they want to, if you want to view our dirty, absolutely. I would love to show that to people.
Okay.
The work that we've kind of gone through on all those. But we really started to size things down to sponsors with a track record, sponsors that have invested in these opportunity zones. I mean, these are tracts and areas of the country that are challenged. They haven't gotten the same kind of capital investment that other areas have. Do you have experience investing there? Kind of important, right? So those are big things that we looked for. And then very specific geographic specificity to what they're doing. A lot of the funds that we looked at, unfortunately, had very broad mandates that said they could invest anywhere. It's like, well, okay, I don't understand. I don't want a black box. Our investors absolutely cannot stand the black box style of investing. I have to understand what the pipeline, the track is that we're going to go down. What will we invest in? So there's a lot of the criteria we use to kind of size down that field. And we really came up with about 12 that we really, really like.
Okay. Do you have a little ditty on those 12?
Oh, I do. I got lots of little ditties on all those. Yeah, so let me take you back to some of the characteristics of opportunity zone funds. There's a tax deferral item here. There isn't a consistent elimination or a deferral of that tax. End of 2026, 12/31/2026, that bill's due, right? So the advantage here is from the time period of today to when my tax is due, I'm earning money on that. So hopefully I'm making returns there that will allow me to suffice that tax bill and then some. That's the play that we're making here to do that. So there was a basis increase if you had invested at the end of, I believe, 2020 or 2021. That's eliminated. So I'm going to cross that number 3 off the list. Sorry about that. Number 4 is a big advantage though. So the asset that you're investing in, or the opportunity zone you're investing in, the gains on that opportunity zone, if you hold that for 10 years, they are tax-free. So you walk out of this thing after a decade and you go, okay, I have money. I've made a return, a good return hopefully. I can invest that wherever I want to without any tax consideration. So that's a huge advantage. The other interesting advantage here that I didn't include on the slides is the comparison of this to a 1031. In the 1031 exchange, I have to invest my entire proceeds in order to get the full tax benefit of doing that. It's not the case here. You only need to invest the basis or what you made on those assets into the opportunity zone fund to get this deferral. The rest of the money, or in essence the basis of what you had in your assets prior, you get that free and clear. So we've done some a little more creative homework here on, okay, I can do the opportunity zone fund. What's the economics on that? And then what's the economics on this other money that I can take and put somewhere else? I could drive higher returns in that in, say, a syndication or other investment vehicle. When I look at that and compare to what I get out of the opportunity zone fund, actually this makes a little bit more sense than doing the 1031 into a different passive vehicle. So this gives an opportunity for us to be more creative and to just show people bigger risk options on the risk return spectrum than we normally would.
Yeah.
So Insight has reviewed the 8,400 funds that are available for opportunity zone funding. You've narrowed it down to 12. And then you offer your investors the opportunity to invest in one of those OZ funds.
That's correct.
That's really cool.
Yep.
You got to
Yep. So to repeat the question in the room. So our role, the question was Insight Investment Advisors. Our role here is that to review those funds and to offer those investments to our clients. And so the answer to that question is yes. And so that's the value that we bring to this equation, is not only in the opportunity zone funds, but also in the Delaware statutory trust and any other syndicated or passive investment will show investors. We're putting them through the gauntlet from a due diligence perspective at a very, very deep level, right? To understand who can perform here and who can provide returns and gains for our clients and who can't. So that is our, in essence, why we exist and why we're here.
Awesome.
Go ahead.
When I invest in your fund, is it a blend of the 12 markets that you've chosen, or is it I get to choose between Seattle and Detroit or whatever?
Yeah, so the question was, if you invest with Insight and work with Insight, are you investing in our fund and across those, say, 12 OZs, or am I picking and choosing which funds to be in? And the answer is the latter. You're picking and choosing where you want to be. So in essence, I'm bringing you a menu of things that I've taste tested and said, these are good, right? And you decide what fits best for you, and we'll have that conversation about what fits best for you in your situation. And frankly, it becomes a lot of preferences about where you want to be, because I've taken the bad stuff off the menu already. So it's just a matter of choosing what you like. Good.
Can you clarify which component of tax deferred, or what component of your taxes that have been deferred are due in 2027? So like if I've done 3 or 4 1031s and then roll it into an opportunity zone, do all of those deferred taxes now become due in 2027?
Yep, the question, and I'll make sure I paraphrase this correctly. So the question was, which gains are deferred in the opportunity zone that are eligible for 2026? In your example, you have multiple capital gains that you've been exchanging over and over again. All of that's due. So that full bill will be due by 20. You're in essence stopping your ability to defer taxes in 2026. So whatever bill that you had when you sold those properties, that bill is coming due in 2026. You're just kicking that down the road a bit.
And there's no guarantee that what happens between now and 26 is going to be good for you. It may be bad for you.
That's correct. Yeah, so obviously there's no guarantee in any of these options about what return patterns are. But what's intriguing to us and there is bipartisan legislation in, I believe, the House right now on opportunity zones to expand these timelines a bit. So we're very optimistic that we get new and favorable opportunity zone laws for investors moving forward. Because in essence, this program is frankly coming to an end from an investment perspective. So we'd love to see an extension here. And my goodness, actual bipartisan legislation. What a miracle. Wow, we found something we agree on.
Thank goodness.
Is it the only bipartisan? No, I'm kidding.
Yeah,
I'm joking.
Apparently so.
Apparently so. So we're optimistic about that. Online questions.
Yeah. One question: what the types of assets that OZs invest in?
Yeah, it's a lot of, you have to do a lot of value. The OZ rules are very specific about the amount of value that you have to add to a property. You see a lot of ground up new construction. See a ton of that. You have to do a massive amount of value add here to qualify, and the opportunity zone structure. The more interesting funds we see are doing some really crazy stuff that feels more like private equity. For example, they're installing broadband in very rural areas in certain states in the country. They're putting in solar panels in rural areas. Some very interesting, more private equity type focus away from real estate. They're picking up businesses and moving them from here to there into an opportunity zone, which is also an activity that would qualify. So I think there's an opportunity in some of the funds to do a bit more, it's called diversification, than normally would. We shy away from the ground up construction that looks like luxury apartment buildings at the edge. The tiny little edge of an opportunity zone, we kind of shy away from some of those opportunities. But there is a little bit more diversity here than just ground up construction that we're seeing.
Good. That's what we got.
How much capital improvements do you have to do to qualify for a property that's being constructed or purchased in an OZ area?
So the question was, how much capital improvements do you need to do to qualify as an OZ? I would love to be able to tell you those rules off the top of my head. I don't know. They are extensive though, and it's something that we see in every piece of offering document of those rules being very specific about starting to follow that. Off the top of my head, I don't know. We'll certainly find out.
This is more of a statement, but we bought a property in an opportunity zone, Highway 285 RV park. But we weren't doubling our basis in the property via capital improvements, so our CPA told us it wouldn't qualify. So just something to think about.
Yep.
Yeah.
Yeah.
You can't just buy a property in an OZ and then automatically qualify. You actually have to improve it.
Yeah. There's a lot of rules there that folks really have to follow. Hence when we're doing this background, it's, man, do you really understand these? Do you understand these rules? Are you able to be compliant to them as a sponsor? So it's probably very good advice from your CPA that this doesn't have opportunity zone qualification because there's so much to do there to make it work.
That's why I think having a well-vetted OZ fund is critical. So if you're going to do it.
Frankly, we saw a lot of people people being sponsors jump into this space because frankly, heck, it's really attractive. I can't count how many billions of dollars have been raised and put against this. It's been a really successful program. But if you're just starting off on investing in these kind of areas, and this is your first venture, I don't think I want to participate. It might go great, but I'd rather have someone with a lot more experience.
Yeah, definitely.
What else can we do? So other options too for passivity. The 721 UPREIT is something that has gained a lot more popularity. And so what is this? So from a tax perspective, what can happen is a real estate investment trust can come up to you and say, hey, I really like your property. I'd actually like to buy it and put it into our REIT. You go, great, I want to sell. This is awesome. They can give you shares back of that REIT, and that's a tax-free transaction. Wow, that's really cool. This rarely happens, right? So again, we hear a lot about this, but it's very rare to happen. What we're seeing more of in our space is sponsors that have REITs utilizing Delaware statutory trust as a bridge. So what you'll do is you'll do your 1031 exchange into one of their Delaware statutory trust. The REIT will come around 2 years later and buy that Delaware statutory trust. Do the 721 UPREIT, and then you have shares, right? So it's another step in transaction that's happening. Why is this beneficial? So I think what we're watching is families in their taxable situation that have a lot of heirs, and they're like, geez, when I pass, how am I going to chop up these huge investments that I have, right? How am I going to chop that up with my five heirs? How would that work? This is the ultimate end game. So now I have shares. Once I pass, step-up basis, I can hand shares out like handing out the decks of a card game, right? It's very easy to do. So we're seeing this become a interesting option for folks as they get close to the quote-unquote ultimate end game of your life. We're seeing this become a bigger option for them to do. So I wanted to throw a slide in there because I think it's nomenclature that we've seen out in the marketplace. I think very few people really understand what a 720 UPREIT even means. So it's definitely an option. Any questions on that? Lots.
So
The question in the room is lots.
But I don't want to bore the group.
Take your best question and ask us that one.
The first question, I think just for general education, what's the difference between a private REIT and a public REIT?
Okay, so the question in the room, what's the difference between a private REIT and a public REIT? And most of the REITs that we're talking about in the 720 UPREIT scenario are private, right? So the public REITs have tradability, right? They have an easier access of liquidity there, and they're tradable on public markets. Privates aren't. Most privates that we look at still do offer a liquidity option, but it varies. Most of the time, it's a quarterly option that they're offering, and there's just a little bit less. To me, in our view, the market gives you transparency into what something's valued, right? So you'll hear a lot of commentary like the market's wrong. Well, too bad, because that's the price today. And so that's the value of your asset today. And so it's interesting to know that from a transparency perspective, and that I can transact there. Conversely, those assets may have a different net asset value if you're evaluating them from a third party. And that's what we'll see more in the private REIT space. And so it's good to have the liquidity there, but I kind of want to know what that asset is and what that asset's valued at. So there is a differentiation there. We sort of historically have liked the return pattern on the private side over the public side, but that could change. Now I'm just rambling about this.
Yeah, no, it's good. How does Insight get involved in UPREITs?
Same way, same transaction that we're doing here. So we're doing the same sort of evaluation of these companies, and we're trying to fit that UPREIT scenario to our clients and to figure out, hey, does that make sense for you to do that? Because the moment that I do a 721 UPREIT, I lose my ability to 1031 exchange again. Right? So that's a big thing for you to leave. Are you comfortable leaving that? Right? Is that something that fits your situation? So we just our job there is to explain to you, here's your options, here's where we think one of these things might fit for you, and here's where they don't. So we're involved the same way that we'd be involved in DST or the other transactions.
And then just to back up there, the question was, how does Insight 1031 get involved in the, and that's cool.
I screwed up.
No.
That's the first one I screwed up.
And if I well, don't hang out with me because I fumble the football all the time, big boy. If I could just kind of back up to a previous question. So by way of a REIT, the REIT structure from my foggy memory is that the preponderance of the income, 85 or 90% of the income generated within the entity is distributed to the investors is kind of the leading characteristic for a REIT. Piggybacking on that, by way of a public versus a private, the public REIT, you hear about exempt securities, and exempt securities or private investments are just securities that don't have to follow the big laundry list of all the requirements by the SEC in the states to be publicly traded. So is it fair to say that generally speaking, a publicly traded REIT is a bigger entity with more seasoned management?
First part, I would say yes. Usually a larger entity, usually broader diversification in there, usually a lot of assets. I've seen a lot of very senior managers in the private space that choose to stay in that private REIT space that we really like a lot. So I don't know if that's a differentiating characteristic of that. It's more the function and the way that they trade and how assets are valued is really where I'd say the defining the differences there. And liquidity, it depends on how important liquidity is to you. I mean, I harp on it constantly. I think it's really important. Some of our investors look at that and they go, Brandon, I really don't care. Like, I'm more interested in the asset and the returns that we're getting. Liquidity is not a big consideration for us. Okay, fair point.
And liquidity in that situation has to do with the sponsor of the deal being able to go to the market and quickly capture what may be $200 or $300 million to take down a project because it's a publicly traded REIT?
No, the flip side of that is more from an investor perspective.
Okay.
It's when can I get my money out?
Yeah. Okay.
Right, and it depends on how important that is to you as an investor, and what other options that you have, and what other things you're thinking about. We harp on it. It's a big point for us. Like, I want you to have access to liquidity. A lot of the options that we've got done talking about today are not liquid, and so we got to spend a lot of time from a planning perspective across folks' entire portfolio and go, okay, do you have a liquidity problem? Like, you might, and then we may want to make different options and different considerations to make sure you have liquidity on hand.
Okay, so we're it's about 12:15 Pacific time.
Okay.
And the feed is going to get shut off in 15 minutes. And we can continue, but in 15 minutes, if we're still going, we'll say goodbye to those online. Back to you.
I'm gonna hold your questions. I'm gonna motor through and then come back. There's some questions in the room. I'll come back to those.
Okay.
Hold them. I'm sure you won't forget. I gotta say this again. I'm not a CPA and I'm not a lawyer. I'm definitely not an estate planner. But I've seen far too many of our clients come to us, I would say over half, who haven't been through an estate planning process at all. They hold assets in their own name, they hold assets in single member LLCs that have a pass-through, and they have no plan for their heirs. So since I got you here in the room and online, please, to God, go visit an estate planner. Go put together a trust if it makes sense for you. Start with a revocable trust. Start with something that has a planning component for you and your heirs. If, God forbid, something may happen to you, please go and do this work. I went and did this work with my wife nagging me to go do it constantly. And she's right. She was right. I'm glad she kept nagging me to go and do this because we desperately needed to do this. And we went through this process with an attorney to have these things in place, and they're critical. And no concern here, too, a lot of the assets that we talked about, the Delaware Statutory Trust, Opportunity Zones, et cetera, a lot of these can be retitled very simply into revocable trust. So it's a very easy activity for us to do. So even as folks are going through this process of, in essence, retiring from active management, getting passive, it's easy for us to make those changes. So I harp on that. I won't spend a lot of time talking about it. Please get your situation in order. From that perspective, your heirs will thank you. So I leave you sort of with this as we've talked about this. The easiest way for you to be successful if we're going through any of these processes is simply have a good team together and to have a plan. It's really as easy as that. Have a CPA, have the right lawyers on board, have an advisor like me if you must, but have a team, have a plan, and things will be all right. And that's how to kind of get in touch with us. Like I said, I'm in Milwaukee. My partner in our home office is in Kansas City. And we're really happy that I was able to do this and come out and be with you guys today. I really appreciate it.
And there's a de minimis rule by way of registration, so anybody in the country can reach out to Team Brandon. And
yeah, 100%. Yeah, we utilize that in certain states, but we're happy to register anywhere in any 50 states to make sure that we're available to help folks.
Yep. Alrighty, so question, those online, do feel free to lob a, okay, look at that.
Ask and you shall receive.
There she be. If I set up a trust, can I transfer my investments with Spartan into the name of my newly formed trust? And I'll take that one. And the answer there is, I'm proud to say, yes. Give us a couple of weeks to get that buttoned up. We can do that.
Good.
Was there a...
There's two in the room.
Okay.
Let's do those.
Go ahead. So for the UPREIT, that seems like it would be a really attractive negotiation tactic if REITs are trying to get into properties that otherwise the sellers might not want to sell.
Mm-hmm.
Why is that not a more common strategy?
I think it is. So the question in the room was why the UPREIT seems very attractive from a REIT's perspective to get into certain markets. Why isn't that more common? I think more of my comment about it not being common is for the investor. It definitely is common for the REIT. So the difference we'll see, and when we put people through this test, we have a couple different REITs that we'll work with on this. And I'll take down the information of your property that you're looking to sell, and I'll bring that to the REIT. Most of the time the REITs are saying no to those properties. So it's more from an investor perspective. The REITs are very active out there offering that as a solution to potential sellers. So from their perspective, yes, it is a very active strategy. From the investors that we see on our side, the answers are usually no, that there's just not the interest from the REIT in those particular properties. So we just haven't found as many matches as we think. I think more often people come to us and say, hey, I heard this happens. Let's do this, right? Like it's this thing I can just turn and flip a switch and do. It's just not that easy.
So my question's a scenario, if I'm an LP with a syndicator who has a collection of, let's say, self-storage facilities in a fund, and it gets attractive to sell to a REIT 5 years down the line, do I get to participate as an LP with shares in the UPREIT?
Okay, so the question in the room is a scenario. It was if I'm a limited partner in a fund, and a REIT finds that particular fund or those properties in the fund attractive, can I participate in the UPREIT transaction? I would kick that to the Spartan folks and ask these guys if you can do there. My first initial blush there is, I think it really would depend on the documents and how that's structured into a way that you'd be able to participate in that transaction. I kick that to you guys though on the Spartan side and say, how would that work for you guys in that sort of scenario?
Yeah. So there is some variability here to the answer, and it's a squishy answer. The upshot is likely yes. That's a complex, forward-looking statement, and don't make an investment based on that answer. But the answer is likely yes. And what Spartan is seeing is our investors, our intention for for an equity investor who is passively investing in one of our funds. The anticipation is that the fund, with no regard to other investors in the fund and their investment decision, to be able to 1031 into the next Spartan investment once the existing fund has come to conclusion.
Mm-hmm.
Following on, it seems logical that the answer is yes, to go up into the REIT.
I'm thinking about my heirs and legacy to them, maybe 50 years from now.
I think, and the comment in the room was you were thinking about your heirs and how that would work 50 years from now, and the non-taxability of that transaction. I think, again, I haven't seen this happen. I really haven't seen this happen, period, in syndication, where the sponsor would sell to a REIT and then turn around and offer those REIT shares to investors. I've never seen that scenario. I imagine that in some cases it would be a tough putt for some of the investors may not be thinking about that REIT the same way. So for some investors could step back and say, well, what is this REIT thing that I own now? Like, how do I do due diligence on this? Do I even want to own this? And to not have the optionality to participate in that or not might be very difficult for some investors to swallow, right, in what you're doing. So I think most investors probably still want the cash in that scenario so they can make their own decisions. And sponsors are probably taking those cues from investors. So I think that would be interesting if that scenario would happen and how sponsors would react, and then how investors would take it would be very interesting to me to watch that play out.
So number one, I am now stealing tough putt. That's pretty good, and I'll be using that in my
Okay,
game. Yeah,
got you.
That's part of the that's the varsity team.
That's
right
your
there.
big takeaway from today.
We can
I'm just
edit
kidding.
this and cut that out.
No, I want that in. You leave that in. That's good.
I'm going to try and tie that concept with a question that came in. The question that came in: what's the difference between a will and a trust? And I'm going to hack at that from the perspective that the will articulates the estate plan. A trust may be revocable or irrevocable. I don't know why I say it that way. That's just the way it is. But the will is going to enact various actions to be put in process at the first or the second passing. So that whole design, be it a generation skipping trust, a dynasty trust, a charitable remainder trust that subsequently feeds a family foundation at the second spouse's passing, all of the will from the question here, the will can just kind of put into play what the plan and the intention was from the owner or the participant or whatever the correct term there.
Yeah, there's there's way more decisions to be made at your end of life scenario that go beyond the trust and your financial components. And a lot of them are related to your health and how your health and healthcare will be handled if you're incapacitated. And so a will is going to walk through a lot more components than just your financials. So yeah, you need both. Yeah. Please get both.
Yeah. Last month we had an asset protection attorney that presented, and a key takeaway for me was that for investment, state of Washington, Melissa and I are residents of the state of Washington. We have assets with Spartan, just around the country. So a revocable living trust streamlines the probate process, which is different for each state. And so for folks that are really active and have a number of assets around the country, there it is. Yeah. So the living trust, it makes a lot of sense. Okay. That's the last question we have online. Any other and I'm keeping an eye, we're 2 minutes away from half past the hour, so we're going to need to say goodbye to the online crew in just a moment. Sean, why don't we connect and then we'll say goodbye to the online crew.
Sure. I guess the timeline for 1031s feels restrictive when you've got 45 days to target, I think it's upward of 3 properties, 180 days to fully close. And so one thing that I've heard pitched, but maybe you can give me some more information on, is called a reverse 31 exchange, where in theory you take your property that you have a little more control over and you just sell it. And now you have more time, I think, to identify and get into transferring.
Yeah, I can help you a little bit. Yeah, it's a thing. So the question in the room was, what about a reverse 1031 exchange? Does that alleviate some of the timeline pressures? And the answer is absolutely. So the mechanics of that are, you're actually going to buy the property. You're going to do it in reverse. You'll buy the property as the replacement property, and then you'll turn around and sell your current property. You can absolutely do that. The mechanics of it get very specific. So I would definitely use and talk to a national qualified intermediary about doing that. The cost to do that from just the qualified intermediary cost, which is usually between about $500 and $1,000 to do that, is about 6 times higher for you to do a reverse. So there is a cost restriction there a little bit from doing that. But if the way I've seen this work and people do it is like, I really want that property over there. Go and get that property, and then worry about this exchange. Worry about doing the reverse exchange on the backside. But you got to really want that property. Otherwise, I still recommend that folks just work the process a little bit, work that process in parallel between selling and buying. Seems to be the more effective solution. It's just the timing of working that process that I think if you change that, the 1031 becomes less restrictive and becomes less of a pain and a nightmare rather than doing the reverse. But I think the reverse plays in when you gotta have that property, and it's a very competitive maybe property to put your hands on. You can do that and set up the reverse exchange. That's a good question.
Oh, that was a good question. Roy, how are we doing on time? Should we say goodbye to the online crowd?
Whatever you want.
Okay.
Yes.
Okay, we're going to pause for just a few seconds here, and for those viewing online, thanks for attending, and hope to see you soon.